We are covering the 6 top actively traded stocks that are bullish today. While watching price actions, let us inform you. Our review on NVDA. NVIDIA Corporation, a leader in computing infrastructure, has been getting a boost lately, and it's thanks to some positive developments around trade policies. The company, known for its dominance in graphics processing units, GPUs, and AI solutions, saw its stock rise after news broke that the U.S. government may ease some of the trade restrictions originally set to hit on April 2nd. These tariffs were expected to hurt industries like semiconductors, potentially raising costs and disrupting global supply chains. However, the latest reports suggest the measures might be scaled back, which has alleviated some of the pressure on the semiconductor sector. As a result, NVIDIA's stock has benefited from this shift, riding the wave of optimism surrounding the easing of these trade barriers. But that's not all for NVIDIA. While trade concerns have eased, the company is also continuing to make significant strides in the tech space. For example, Cognizant recently launched a new AI platform powered by NVIDIA's technology. This platform is designed to help companies accelerate the use of AI, which has become one of the most critical tools for businesses across a wide range of industries. By partnering with Cognizant, NVIDIA further solidifies its position as the go-to provider for the infrastructure that drives the AI revolution. This partnership underscores NVIDIA's ability to provide the necessary technology to support businesses that want to leverage AI and big data, key areas that are expected to see explosive growth in the coming years. Beyond that, NVIDIA's role in the data center and AI market continues to expand. The company's compute and networking segment, which includes data center accelerated computing platforms and AI solutions, is growing at a rapid pace, driven by the increasing demand for AI and cloud computing services. With the likes of autonomous vehicles, robotics, and high-performance computing all becoming more prevalent, NVIDIA's GPUs and AI platforms are at the core of this digital transformation. The company's product lineup, which includes its flagship GeForce GPUs for gaming, along with its more enterprise-focused offerings like the DGX and Omniverse platforms, ensures that NVIDIA is integrated into both consumer and enterprise markets, giving it a diverse revenue stream. For investors, this news is significant. The combination of easing trade tensions, strong technological leadership, and continued growth in AI and cloud computing makes NVIDIA an attractive stock. The company's consistent innovation in AI, machine learning, and gaming positions it well for long-term growth. If you're looking for a company that's not just weathering market challenges, but is also strategically placed to capitalize on the future of tech, NVIDIA seems to be a prime candidate. The stock has shown resilience and strong performance, and with AI and other high-tech sectors expected to continue booming, NVIDIA's position as a key player in those industries only strengthens its growth prospects. In short, NVIDIA's recent developments, along with its deep involvement in the cutting-edge sectors of AI and computing, make it one to watch in the coming years. Our review on TSLA. Tesla Incorporated is back in the spotlight after its stock soared more 11% on Monday, marking its biggest one-day jump since November. This spike came after reports suggesting that the U.S. government may scale back some of the upcoming sector-specific tariffs, a piece of news that's ignited some serious optimism in the semiconductor and electric vehicle (EV) sectors. After a tough start to the year, with Tesla's stock dropping nearly 40%, this rally was a welcome sight for investors, especially retail traders who had been staying on the sidelines for a while. The trade uncertainty had raised concerns about rising costs and supply chain issues, so news of tariff reductions is a positive signal that's breathing new life into the stock. But beyond the tariff news, there's a bigger picture here. Tesla has been dealing with a range of challenges that have put pressure on its stock. Competition in the EV space is ramping up, consumer demand for electric vehicles is softening, and there's ongoing chatter about CEO Elon Musk's political distractions, which some investors are worried could hurt the brand's reputation. Despite these headwinds, Tesla's market leadership remains undeniable, especially in the U.S. market, where it continues to hold a dominant position. The company is also deeply embedded in the energy space with products like Powerwall and Megapack, which are helping it diversify beyond just cars. Even with its market dominance, Tesla's high valuation continues to raise eyebrows. The stock is currently trading at a massive 85 times earnings expectations, which stands in stark contrast to the low, single-digit multiples seen with traditional automakers. That high valuation leaves some investors wondering if the stock has room to grow or if it's overhyped. And that's where the real tension lies. While Tesla's ability to innovate, especially in areas like autonomous driving, robotics, and energy storage, suggests massive long-term growth potential, the current stock price may not necessarily reflect the risks that come with its ambitious plans. The latest surge in Tesla stock is largely due to the tariff optimism, but this doesn't completely erase the challenges the company is facing. The reality is that Tesla's future still hangs in a delicate balance. The company is working on several key innovations, like the upcoming Cybertruck and its expansion into autonomous driving, which could give it a major competitive edge. However, these projects are still in the works, and there are many unknowns when it comes to how quickly they'll be rolled out and whether they'll meet investor expectations. There's also the issue of market volatility. The broader market in general is a bit jittery, and that uncertainty isn't going away anytime soon. Investors are keeping a close eye on how Tesla navigates these turbulent times, especially with the looming tariff policies and the global economic climate. For now, the stock's recent bounce has brought back some bullish sentiment, and analysts are still optimistic about Tesla's long-term prospects. However, many are also warning that the stock remains highly sensitive to market shifts and policy changes. So while the recent rally is encouraging, it could be short-lived if broader economic challenges persist. In the end, the next few months will be critical for Tesla. Investors will need to carefully assess how the company moves forward with its innovations and whether it can maintain its competitive edge in the face of growing challenges. If CEO Elon Musk continues to execute on his vision, Tesla could be positioned for some serious growth in the coming years, especially as autonomous driving and energy solutions become even more central to its business model. But for now, the stock's high valuation, the competition it faces, and the broader market conditions suggest that caution might still be the best approach for some investors. Keep an eye on upcoming news and earnings reports because, as always with Tesla, there's bound to be more volatility ahead. Our review on PLTR. Palantir Technologies Inc. has been making waves lately, with its stock continuing to climb as investors start to feel more confident about the company's future, particularly its role in the AI sector. The shares saw a solid bump, driven by increasing recognition of the company's AI capabilities and its growing government contracts. If you've been following Palantir, you know it's been a roller coaster ride. Just last month, the stock took a significant hit, but in the past 2 weeks, it's bounced back with more than 20% in gains. A lot of that optimism can be credited to the company's recent AI showcase, AIPCon 6, where they rolled out some exciting new partnerships and highlighted real-world successes. For Palantir, AI is no longer just a buzzword. It's become the core of their future strategy. CEO Alex Karp's latest book, The Technological Republic, stirred up some debate and criticism, especially from economists like Jason Furman, who found the book's policy recommendations lacking. But even with some controversy surrounding Karp's ideas, the market has been rallying behind Palantir. The company is growing its influence in the AI space, and its market cap has now surpassed major players like Lockheed Martin. That's a pretty significant milestone, and it only adds to investor optimism. But while there's a lot of excitement around Palantir, not all investors are ready to dive in headfirst. Some, like top investor Stephen Fiorillo, are cautioning against rushing in. Fiorillo sees potential red flags, such as the large portion of Palantir's net income being tied to interest on its cash reserves, a source of income that could dry up quickly if interest rates shift. He also raised concerns over the sharp rise in stock-based compensation, which jumped dramatically in the last quarter. This kind of compensation can be a double-edged sword. It can dilute the value of existing shares and raise questions about the company's cost discipline. Then there's the valuation issue. Palantir stock is currently priced at a steep 91 times its projected 2027 earnings. That's far higher than AI peers like NVIDIA, which trades at just 17.77 times its projected earnings. While Palantir has proven its ability to create valuable software and execute its business plan, Fiorillo believes that the high valuation makes it hard to justify being overly bullish, at least in the short term. So, while there's definitely momentum on Palantir's side, thanks to its growing AI capabilities and government relationships, the stock's current price might be a bit rich for some investors. Wall Street seems to be on the fence too, with a consensus hold rating on the stock, meaning analysts are cautiously optimistic but not fully convinced that the stock is a strong buy at these levels. As for Palantir's future, the company's position in AI and its role in national security projects could certainly drive more growth, but investors will need to keep a close eye on its valuation and the broader market conditions. This one's a bit of a wait and see, with a lot of potential but some risk mixed in. Our review on QBTS. D-Wave Quantum Incorporated has been riding a wave of momentum lately, with shares jumping 15% over the past month. If you've been following the quantum computing space, you know it's been a bit of a roller coaster. Big spikes in excitement followed by sharp corrections. But despite the volatility, D-Wave continues to push forward, making real technological strides that have caught the attention of investors. The company recently unveiled its Advantage 2 prototype, which has outperformed classical supercomputers in material simulation, an impressive feat that reinforces the potential of quantum computing. On top of that, D-Wave announced a new blockchain architecture that leverages quantum computing to enhance security and efficiency. These are the kinds of advancements that keep investors engaged, even as the broader quantum industry remains speculative. That said, the quantum computing sector as a whole is still in its early days. Some big names in tech, like NVIDIA's Jensen Huang and Meta's Mark Zuckerberg, have suggested that practical quantum computing could still be 10 to 30 years away. Others, like Bill Gates, think a major breakthrough could happen in the next 3 to 5 years. This uncertainty makes stocks like D-Wave and Rigetti highly volatile. One big announcement can send them soaring, while skepticism can quickly pull them back down. Financially, D-Wave has had its challenges. The company reported increasing losses, but also completed a $150 million equity offering in January, helping fund its operations. It also had to regain NYSE compliance after an auditor's warning about its financial stability last year. Despite these hurdles, the stock has delivered an eye-popping 301% total return over the past year, significantly outperforming the broader market and the software industry. A key part of D-Wave's strategy has been forming partnerships to showcase real-world applications of quantum computing. Last year, it collaborated with NTT Docomo to reduce mobile network congestion and teamed up with Japan Tobacco to explore quantum applications in drug discovery. More recently, it launched an on-premises quantum computing system and established a research partnership with Germany's Forschungszentrum Jülich, reinforcing its commitment to expanding quantum's role in business and research. So, where does that leave investors? D-Wave is making real progress, but quantum computing remains a high-risk, high-reward space. The technology is still developing, and revenue generation remains a question mark for many players in the field. While D-Wave has shown it can innovate, its financial health and the timeline for quantum's mainstream adoption are factors that investors need to keep in mind. For now, it's an exciting story, but one that still comes with plenty of uncertainty. Our review on SOFI. SoFi Technologies Inc. has been turning heads lately, proving that it's more than just another fintech trying to carve out space in a competitive market. As a digital-first, one-stop shop for financial services, SoFi has built a strong member-centric ecosystem that spans lending, banking, and investing, all under one roof. And despite growing concerns about a potential recession, the company continues to show resilience and long-term potential. The stock has been on a bit of a ride, like most fintech names, but SoFi's diversified business model gives it an edge. Its lending segment, which includes personal loans, student loans, and home loans, has been a key revenue driver. With interest rates fluctuating and student loan repayments resuming, this part of the business is facing some headwinds. But SoFi has managed to keep growing thanks to its strong underwriting process and solid customer base. Where SoFi really stands out, though, is in its tech platform and financial services segment. The company's technology arm, which powers banking infrastructure for other institutions, continues to expand its influence. This side of the business is more stable than lending and helps diversify revenue. Meanwhile, SoFi Invest and SoFi Money have been growing steadily, attracting more users to the platform and increasing customer engagement. Of course, the big question is, can SoFi keep up this momentum if the economy slows down? Recession fears are hanging over the financial sector, and fintechs are often hit harder in downturns because consumers tighten their wallets. However, SoFi's push to become a full-fledged bank, thanks to its national bank charter, gives it a major advantage. By holding deposits, it has more control over its funding costs, unlike some of its competitors that rely on external lenders. That's a big deal, especially when credit markets get shaky. Investors seem to be taking notice, and while the stock remains volatile, SoFi is positioning itself as a long-term winner in the fintech space. If the company can keep growing its customer base, expand its tech platform partnerships, and maintain strong lending discipline, it has the potential to weather economic uncertainty and come out even stronger on the other side. Our review on AMD. Advanced Micro Devices Incorporated is having a strong start to the week, with shares surging nearly 7% on Monday. The big catalyst? Reports that the U.S. may scale back or even exclude certain sectors, potentially including semiconductors, from the upcoming April 2nd tariffs. If that happens, it would be a major relief for AMD and the broader chip industry, which has been navigating uncertainty around trade policy for months. For AMD investors, this rally is a much-needed break from what's been a rough stretch. Over the past 6 months, the stock has taken a hit, dropping about 30% as demand for personal computers and traditional servers has weakened. The semiconductor market has been under pressure, and AMD has been dealing with stiff competition, especially in the AI space, where NVIDIA has been the dominant player. While AMD has been making moves to catch up, it hasn't been an easy road. But here's why some investors are still optimistic about AMD's future. The company has been making steady progress in the AI chip market, with its MI300X accelerator starting to gain real traction. AI is the hottest sector in tech right now, and while NVIDIA still owns the lion's share of the market, there's room for AMD to carve out a solid piece of the pie. The demand for high-performance AI GPUs is only growing, and AMD has been securing more customer orders. On the consumer side, AMD's PC CPU business is also showing resilience. Ryzen processors continue to gain market share, driven by performance improvements and new partnerships. While the broader PC market has been sluggish, AMD's ability to compete with Intel in this space is helping to keep things moving in the right direction. That said, not everyone is convinced that AMD's rally is sustainable. Some analysts believe the stock could trade sideways in the near term as investors wait to see if the company's AI chips can truly challenge NVIDIA's dominance. There are also concerns about potential oversupply in the PC CPU market, which could put pressure on pricing and margins. And, of course, trade policy remains a wild card. If semiconductor tariffs end up being implemented after all, it could create new headwinds for AMD. For now, though, the market is responding positively to the possibility that chip companies might be spared from tariff-related disruptions. If the U.S. does take a more measured approach to trade policy, it removes one of the big uncertainties that has been weighing on AMD. Add in growing demand for AI hardware and continued strength in its CPU business, and it's easy to see why some investors are staying bullish despite recent volatility. AMD's story is far from over, and with AI and high-performance computing driving the next wave of innovation, this is a stock that will remain in the spotlight. Whether it can keep pace with NVIDIA and capitalize on AI's explosive growth is the big question. But for now, the company is showing that it's still very much in the game. Please subscribe, give the video a like, and watch more from our playlist. Thanks.